While we're all busy tracking company earnings and stock fundamentals, there's a much bigger game being played behind the scenes. It's a geopolitical chess match, and its moves are quietly reshaping the global economy and your investment returns.
And no, this isn't just some distant political squabble you read about in the headlines. We're talking about a powerful macroeconomic force that is a direct line into your portfolio, whether you realize yet or not.
So, what exactly is this silent trade war? Well, you can forget about grand declarations and formal announcements. This is a battle fought with these kind of under-the-radar policy shifts, sudden tariffs, and strategic supply chain squeezes. And right now, India is caught squarely in the middle of that U.S.-China rivalry.
All right, so to really get a handle on the impact here, we first have to understand the players. Because this isn't some simple two-sided fight, it's a really precarious economic triangle.
Okay, so here's the core of the problem, the fundamental tension. For India, the United States is one of its biggest, most critical customers. But, and this is a big but, China is its most critical supplier, providing all the essential parts and pieces that fuel its manufacturing engine. You can already see where this gets complicated.
And the numbers really do tell the story here. Take a look. With the U.S., India is running a pretty healthy trade surplus of around $27 billion. That's a profitable relationship. But then you look at China, and wow, it's the polar opposite. A staggering $99.2 billion deficit.
I mean, just look at the difference on this chart. The scale of this deficit is just enormous. This isn't just a simple trade imbalance, folks. This represents a deep economic dependency that gives Beijing significant leverage over Indian industries.
That number right there, $99.2 billion. That's India's record-breaking trade deficit with China. It's a massive economic vulnerability, and it exposes Indian manufacturing to all sorts of supply shocks and price games as this whole trade conflict heats up.
Okay, so we've mapped out the battlefield. Now let's take a look at the weapons. How exactly is this silent war being fought? Well, it's all in these subtle, sneaky, incremental policy moves.
You can see how it escalates, right? It's this series of moves and countermoves. It starts in March, China slaps tariffs on U.S. goods. A few months later, bam, the U.S. retaliates, not just against China, but with a broad 25% tariff on Indian goods. Every single step just raises the stakes.
And when you dig into the specifics, it gets pretty sharp. The U.S. is now targeting a whopping 2/3 of India's exports with penalties that could go as high as 50%. And the official reason they're giving? India's trade relationship with Russia. But really, it's a clear shot in this bigger geopolitical game. And of course, this creates a ripple effect, with China's own tariffs jacking up costs for any Indian companies caught in the crossfire. And look, these are not just some minor trade spats we're talking about. They are powerful macroeconomic levers. The collective impact is big enough to actually shave points off India's entire national GDP growth forecast. That's a huge deal.
All right, so that's the big global picture. Now, let's bring it right down to the bottom line. How does this whole policy war actually translate into a direct hit on corporate earnings and, at the end of the day, your wallet?
Just let this sink in for a second. More than half, 55% of all Indian shipments to the U.S. are now directly threatened by these new tariffs. We're talking billions and billions of dollars in trade that's suddenly at risk, creating massive uncertainty for some of India's biggest industries.
And for the sectors getting hit the hardest, like textiles, the potential drop in revenue is a staggering 70%. We're already hearing reports that U.S. buyers are putting orders on hold or demanding that Indian companies just absorb the new duties, which, let's be honest, is just not sustainable.
So this is the direct chain of events, the domino effect that you absolutely need to understand. First, a policy is announced in Washington. Next, export orders get canceled or stalled out in Mumbai. Then, corporate earnings for those exposed companies take a nosedive. And finally, the stock price falls, which impacts your portfolio. See? It's a straight line from policy right to your wallet. And for these exposed companies, we're not talking about some small dip here. Analysts are warning about a potential 10 to 20% hit to their earnings per share, their EPS. This is a direct blow to the profitability of huge sectors like IT, pharma, and auto components that really rely on that U.S. market. So, what does that actually mean for you, the typical diversified investor? Well, even if you're not all in on one of these sectors, the drag from this trade war could pull your overall portfolio returns down by an estimated 5 to 10%.
That is a huge headwind, created entirely by geopolitics.
So what do we do about all this? It's easy to feel kind of powerless against these huge forces, but there are definitely clear lessons here, and some smart strategies for navigating this macro storm.
And if there's one thing you take away from all this, let it be this. Right now, in this kind of world, a single policy announcement can completely wipe out months of strong corporate earnings. You see, geopolitical awareness isn't optional for investors anymore. It's absolutely essential.
So, what can you actually do? What are the actionable steps? Well, diversification is key, of course, but think beyond just sectors. Think about geography. Maybe consider tilting your portfolio toward companies with a strong domestic focus, to insulate them from these export battles. Explore growth in other regions like Southeast Asia. And in times like these, traditional safe havens like gold can offer some stability. But above all, you've got to stay informed.
At the end of the day, the world of investing is changing. These quiet moves by policymakers can and will create the loudest noise in our portfolios. So the real question you have to ask yourself is, in a world of silent wars, is your portfolio truly prepared for the noise?